Good morning,
Yeah.
everyone. You're very welcome to our latest webinar in our Build and Scale webinar series. So this morning's webinar is on, sorry, trigger happy on me today is director pensions, the tax opportunities most Irish directors are missing. So a little bit about Kinore. We are an Irish accountancy and company secretarial practice with an audit practice under our group as well, only audit. So Kinore has little under 100 employees working with us across all the various areas in the business. We support clients with compliance, management accounting, their payroll, bookkeeping, VAT services, as well as keeping themselves compliant with the CRO. Joining me this morning is Tom Francis, Head of Accounting at Kinore. So Tom manages a number of our accounting manager teams and has a number of accountants working under him. Tom is our expert guest and is going to take us through a number of areas today on PRSI classification, occupational pensions and PRSAs, employer pension contributions and year-end deadlines and pension access, to name but a few. It's important to note that today's webinar is for general information purposes only. We always recommend, for specific advice, reaching out to an expert and having a discussion with an accountant or a financial advisor. This is purely just for sharing some information with you. So I'll hand over to you, Tom, as you take us through some of those key topics, and then I'll pose any questions that any of our attendees have on their behalf. So do engage with us, use the Q&A feature, and ask any questions that you have. Thanks, Tom.
Um, Thanks, Christina, for the lovely introduction. You know what, when I think back of the webinars we've done previously, we would always have talked about pensions, but I think this is the first webinar we've actually done on pensions. So I think it's a great
Mm,
opportunity just to just to focus in on that particular area, because
yeah,
like over probably over the years, business owners would often come to me and tell me, look, I want to take out 100,000 out of my business. What's the
yes,
best thing to do? And you kind of default just to would salary, dividends. That's the business owner is thinking. Which one is it? Which one should it be?
right.
Um, and while they're they're the main routes to get money out, they're not the most efficient. So like the reason for that is because once you take that, a big chunk is gone with income tax, USC and PRSI and all that. So you end up with less than half that in your hands.
Yes.
Now, if you take that same 100,000 and take it out of the company as you're planning to do, but pivot and send it to pension, the difference is you get full tax relief. The funds grow tax free, and later come retirement age, you have much more efficient ways of taking that money out. So
Hmm.
it's the same money, different outcome. And I suppose really that's what the focus of today is about. It's making sure that the outcome is probably the most efficient for the money that's been taken out. So what we're talking about really is money being taken out from the business potentially in the wrong way, opportunities being missed, and probably decisions happening a little bit too late as well, Christina.
That's
So
absolutely fair. Yeah, like
yeah,
it's all about when it comes to taking money efficiently out of the business, it's all about timing, right, Tom?
it's all about timing, and I think we'll touch on
Hmm.
that as well this morning.
Yeah.
So we look at where things could be going wrong, what good looks like, and where the real opportunities are. So we'll start with the PRSI, because I suppose it starts with the basics, getting the basics right. So PRSI for directors, class PRSI generally only applies where you control more than 50% of the company. So you're controlling shareholder director. And where it tends to go wrong is with multiple directors. So, for example, you might have two directors who are 50-50, or you could have several equal shareholder directors as well. And in those cases, the thing is, nobody automatically qualifies. Um, and a decision has to be made on what the correct rate of PRSI is. Now, often what is actually needed here is a decision from social welfare. So the scope section of social welfare would often give the decision, because PRSI gets set one way and it's left at that. And sometimes actually it might be set correct at the start as class A or class S Class S is, when I talk about Class S or Class A, S is the one that it's the PRSI rate that applies for controlling directors effectively. A is for non-controlling, so where you wouldn't have a controlling, percentage of the shareholding, that kind of thing. Now, what we found in practice, Christine, is it's set correctly at the start, but then things happen during, maybe during the early years where there's share issues happen, different, shareholders come and go, and then suddenly I'm a non-controlling shareholder where I was a controlling shareholder, and PRSI rates then are you might be on the wrong PRSI rate and underpaying PRSI over, and that's the risk, I suppose. If PRSI is wrong, revenue can come back years later for years interest and penalties. And the painful point is like that potential liability sits with the company and not the payroll providers. So I suppose clean takeaway here will be, look, if you don't clearly own more than 50% of the shares, don't don't guess your PRSI class. Safer to get a decision and keep that decision on file, and it can definitely save some pain at later stages, Christina.
Yeah, that's really important to note, isn't it, Tom? Because you can hope that you're that PRSI class, but as you
Yeah.
say, at one point in time is not a good enough justification for revenue. And
Mm.
that clawback that they can come back, is there a limit to the amount of years that they can go back?
Well, like in practice, revenue
Mm,
can go back 4 years. That's what they tend to do.
right.
So
Okay.
like I haven't seen them go back beyond that, but they could
Yeah,
they could
they
do
could.
like if it's wrong, if it's clearly wrong, but tend to go back 4 years. I suppose for anybody here listening, like you want the correct
Yeah,
PRSI class there, because
yeah.
ultimately that all feeds into entitlement your social welfare entitlements as well.
That's it.
But yeah, 4 years is generally the limit that revenue go with.
Perfect. We've had a question there from Enda just asking what if shareholding is 50-50 between two directors?
Yeah, so exactly. So,
Hmm.
and that was one of the points I made earlier. So,
Yeah.
if it's 50-50, you could say, well, one was more than likely class S, but it mightn't be,
Hmm.
because there could be one. It's for example, in that setup, there could be one director who's clearly in charge, and there might be one who isn't. But on paper, the 50-50 thing, you could probably debate that. Yes, in those situations, though, what we would do is we would just get a decision from the scope section of social welfare, just so
Yeah.
there's no ambiguity later. So they could say, "Yeah, I agree with your thought for it. Mine's there, and what you're thinking. That all makes sense." Class S, or they could say, "No, no, no. Actually, based on the information you've given me, that's actually Class A," and so on and so forth. So
Right. Yeah.
I would just say, like, if in that situation, we just, I think, get a decision and you have it in writing then. And if something changes later, you can always get an updated decision.
Yeah. Perfect. And hope that thanks, Enda, for letting us know that that was helpful. Um,
Okay. So, Christina, the next part we'll go into then is
yeah.
pensions. But before I go into like
Hmm.
occupational and PRSAs, just want to touch briefly on auto-enrolment, because there is an update this month as well on auto-enrolment. So I just want to touch on that. But I suppose when we talk about auto-enrollment, there is and has been a lot of noise around auto-enrollment. Like in 2026, it kicked off. Effectively, the total contribution is 3.5% between what the employee puts in, the company, and the state. And it's fine for what it's designed to do, get people onto pensions. But for a company director, the key point is it's not a pension strategy at all. It's really just a starting point. Some some directors in practice might be auto-enrolled. So
Right.
I've just paused there a little bit, because um, if a director is not already on a pension through payroll, um, you could be auto-enrolled. If you already had a pension through payroll, you're excluded. And if you're not
Hmm.
taking a salary, you're outside of the scope as well at the moment. So in simple terms, then, like, you'll only be auto-enrolled if you're on PAY and you don't have something in place. Now, that could have happened. Like what we found was, like, last November, December, the coding of the tax credits happened. So if pension wasn't, if there was no pension deductions going through payroll, revenue automatically coded auto enrollment in. and it was very, you couldn't opt out until now. You can opt out now, July
Okay.
2026. It's a 2 month period now where you can opt out. Um, so I suppose that's the major update here. It's only a short window, months 7 and 8, July and August. You can get your contributions back, and you can still qualify and be brought back in later if you want or wish. But
Yeah.
for business owner directors, as I said, it's not a strategy. Important to be aware of though for any employees that are on your teams here, because they have the option to opt out or pause their contributions now. And I just thought I'd bring that to the table today.
I think it's a really important point, Tom, because as you say, any director that's gone into auto enrollment, it's not a strategy, and it may have happened accidentally where they have a private pension and they just didn't have it going through the payroll, whatever it may be. But
Yeah.
it's really important that you're not relying on that to be your only pension strategy, and that's one of the key takeaways that you want to take from here, as well as the fact that if you inadvertently find yourself opted in, that
Mm.
now's the window of opting out again, right?
Absolutely correct. Yeah. So just
Yeah,
if you're in it, get out of it and get yourself over to maybe the occupational or PRSA, which we'll talk about next.
perfect.
For employers on the auto enrollment though,
Hmm.
important to note that employers can't influence or pressure staff to opt out, because obviously there's a
Right.
cost associated with employers around auto enrollment as well, because the
Course.
employer has to contribute. So there's penalties around that. So employees, if they are stepping out of auto enrollment, have to do it at their own free will. But
Mm.
other than that, I think yeah, it's just a timely update. I think now for our attendees there this morning.
Yeah.
So
It
yeah,
might be just, I have a question that was submitted in advance. Is a pension contribution possible when you're not drawing any salary from the limited company? Tom, I don't know if that's suitable at this time or if you're covering that at a later point, but yeah, it was
I
just
think
one
we
of the,
cover. I think we touch on it as we go.
okay, that's fine.
Very difficult is what I would say. Very
Mm,
difficult to even with either of the main types, because
mm,
a lot of the time salary is a factor in the contributions that you can make. But we,
yeah,
we might touch on that as we work through as well. But I think it's a good worthy question as well.
perfect. Okay, thanks, Tom.
Okay, so we'll jump over then to the occupational pensions.
Yeah.
So really, Christina, like I would say, the more traditional setup. So,
Hmm.
company pension scheme, essentially
Yeah.
is what we're talking about here. The company puts them in place and controls them. They definitely allow for more structure, more tailored benefits, but they're kind of heavy, I suppose, things, heavy structures, heavy, admin, heavy cost, complexity.
Hmm.
Um, these usually set retirement age and limited early access. And when they really come into their own, though, is funding, because there's no annual cap with how much can be dropped into these occupational schemes. It
Okay.
is, as to kind of touch on your question earlier. The funding is based on salary, but also service, years of service and age particularly.
Hmm.
Because why really occupational schemes come into their own is because later in your career, like as you're planning for retirement, you can sometimes make quite large contributions. At the moment, the max pension funds is 2.2 million. So companies can contribute up to 2.2 million. Um, and I suppose as business owners are coming towards retirement, or I suppose particularly as the company maybe kind of gets into a stride and has some spare cash, with
Hmm.
occupational schemes, it allows company owners, directors to make quite large contributions, employer contributions. Now we're talking about there's no one paying anything out of their own pockets here. The company is making the contribution. The company is taking the expense and getting the tax write-off. So they can be very effective in that way. I think the key limitation, as I see it, with the occupational schemes is that if the company is an investment company, so like
Right.
if it happens to be in the business of investments as opposed to like trading. So if it's not like carrying out a trade or a professional service, but it's an investment company, so maybe it's got properties, or maybe it's got other investments on that it trades. Um, that route isn't available for investment companies. So it's really the strong option, but for the right type of business. And the main plus on those ones is you can make those big lumpy contributions, Whereas with PRSAs, which you look at in a second, they're much simpler. They're much simpler in terms of their structures, but they don't tend to allow for those big lumpy top ups because your contributions are pretty much matched to the salary you take out any given year. So if your salary is
Okay.
€50,000, contributions tend to be limited to that same number. Anything over in excess of that, you could actually get taxed as benefit in kind. So it's almost like self-defeating. So
Yeah.
you're kind of limited. So if you take out a really big salary, that's grand. You can
Yeah.
take out you can pay in a really big pension. But just that anything over and above that can be a taxing event, in fact.
Yeah.
So yeah.
And so, Tom, would your recommendation be that everyone should have both if they can manage
Well, do you mean
to have both the company pension plan
hmm.
and,
Well, that's a good question. And it's kind of a curveball question, actually,
sorry,
because the occupational one, I think when you say company, you mean
yeah,
occupational.
yeah,
Um, you would tend to have like what I would actually just say is whatever you do here, don't spend any of your own money in topping up these things. Let the company pay it. Let the company
right,
get the tax write-off. Save your own personal funds. Because I think, when you look at PRSAs, you can do employer contributions just like occupational, but you can also do employee top-ups. So you'd often hear about employees doing AVCs. They call them additional voluntary contributions.
yeah,
For company owners, directors, I would say don't go there. You don't need to go there really. I would just say just max out your contributions, whether you're on the occupational or the PRSA.
yeah,
Yeah, no, it's a good question. So any client I would work with over the years, it would be an occupational or PRSA pension, but
okay,
only company contributions going into them, you know.
right,
Now,
yes,
if you look at the PRSA then, which I'll just touch on now, like the
yeah,
company can fund it, as I said,
mm,
but the flexibility is different because it's not kind of a heavy machine that the occupational one is. It's kind of, earlier access, from 60, sometimes earlier.
mm,
You tend to have more control over how and when you take the benefits. But as I said to you, on the contributions though, the company can broadly contribute up to your salary each year. So as I said,
right,
50K salary, 50K contributions. If you
yeah,
go beyond that, you're into what they call benefit in kind,
right,
and it doesn't become as efficient then.
mm,
So once it's structured properly, it can work well. It's portable. It can travel with you to different employments. It's all good there. It
yeah,
does work for investment companies. That's a big one. So like where
okay,
I have clients who are investment companies, they tend to use the PRSA because it works for them. For the business type,
yeah,
so for a lot of SME directors, it's definitely a cleaner, more practical option. But I would say particularly if it's an investment type company, or if you just want a kind of a lean down machine and you're happy to max out your contribution, similar to your salary, you know. Um, so if you so to summarize, maybe Christina,
yeah,
company funded pension with minimal contributions is probably what I would say the way to go. So go with the
mm,
occupational company funded one with minimal contributions. Um, and the big thing is instead of taking money out now and paying tax on it, you leave the money in the company and extract it through the pension. It's simply the most tax efficient thing out there for extracting funds. That's just you kind of have to stop there and just let the silence hang because there's nothing better than it.
and timing is really important. You mentioned that earlier, Tom. Is there a
Mm,
particular, like, can you do it, when you've figured out, okay, well, I want a tax write-off of X because I've done my accounts and my
yeah.
corporation tax bill is going to be Y, and I want to, take the money out of the business and get that tax write-off. Is that possible?
Timing is really important. I think with most things, but I feel particularly with pensions, like with bonuses, you can pay bonuses out after the year end and get the tax write off in the in
Okay.
the for the year. Pensions is different though because
Mm,
like let's say now we're on the 8th of July,
hmm.
and if our year end is um June 30th of June 2026, if I
Hmm.
pay into if I pay that lump sum in now for my year end June, I won't get the tax write-off for June. I get it for this current financial year. So the idea is you have to pay it into the fund
Yeah.
within the financial year. So it could be on the last day of the year, but it has to be paid out of the company bank account in that year over. That's the crucial part with timing. Um,
Okay.
so now the difficulty can be sometimes like not knowing, first of all, like not
Yeah.
knowing that that's what I have to do. But secondly, then it's not knowing like the results, like the I suppose broad, the broad results of the business as at that stage. So if my
Yeah.
accounting records are reasonably up to date, I do regular bookkeeping, maybe I do management accounts. I'll know fairly well what my
Mm.
profit's going to be and what the business can afford. I know what's in the bank also,
Yeah.
but I know what my profit's going to be and how much corporation tax I might save if I did that lump sum now.
Yeah.
Yeah. So I think timing is key, but only probably armed with the right information as well, I feel.
Okay. Yeah.
Mm.
And even like I suppose we would have a large number of clients that only talk to us when their accounts are due,
Yeah.
whereas we're always open to them giving us that call before their actual deadlines, before they get to their year end, having that little strategy call before they get to their year end, because as you
Yeah.
say, you have to be armed with the right information, but there's no doubt that we would be able to support that in some way. If they need support with getting their bookkeeping turned around quickly or something, it's about reaching out and asking the questions at the right time as well. It's not sitting back, because the last thing a business owner wants is to hear you should have called me earlier. So what that could
Yeah.
be a big takeaway from the meeting today or from the webinar today would it be for reach out to your accountant.
Yeah, and it could be a case where you don't know. Like I don't
Mm,
know what I need to
mm,
know, but I know I don't know everything, or I know there's probably something I'm
that's
missing
it.
out on.
Yeah,
Maybe like if you know your end is 30th of June or 31st of July, just
yeah,
just just touch base with your accountant, and even a couple of weeks beforehand.
yeah,
It could just be like a 15-20 minute call or whatever,
that's it.
just to talk through the options because you probably have the most opportunity maybe at that stage because you're pre-year end and if there's something to do in pensions or something else
Hmm.
then's the time to do it, but do reach out. Yeah. That's probably the main message here.
Yeah. Okay. Thanks for that, Tom. Then just on like, if you ended up having to make a payroll adjustment, do you get any penalties for making that payroll adjustment, or what are the consequences?
Yeah. And it could be payroll, it could be VAT, it could be any tax head really, but we'll stick to payroll here for the question that's been
Mm,
asked. Like let's say if I need to do an amended payroll. Actually, we had a situation there a few weeks ago
okay.
where we had to do that actually
Oh.
because the issue was the director was taking a regular salary, right? So let's say I don't know, €3,000 per month, net, and we're just picking a number for argument's sake here now.
Hmm.
So that was being processed through payroll. But what
Right.
we didn't have visibility on because the bookkeeping wasn't being we weren't doing the bookkeeping for this particular client. They were looking after their own, but the bookkeeping wasn't kind of up to speed, up to the previous month, or it was kind of out,
Right.
it was a bit out of date.
Backlog. Mm,
A bit of a backlog, and that's okay. That can happen. But where the opportunity is probably missed here, I feel, was like there was monies being taken out also that were other personal monies that were coded to the director's account. So the director's account being like other money you're taking out
hmm.
that's not taxed through payroll, let's say, right?
Right.
So what had to happen in that situation then was an amended payroll had to be filed. I think it was for March year end, and
Okay.
like to your point, then you can amend the payroll, but almost certainly there'll be interest charged, like because revenue will see like, well, you didn't pay the tax when it was due, so there's 3 or 4 months of interest due there on that.
Yeah. Hmm.
Um, they can charge penalties as well. I haven't seen them doing it, but they
Okay.
could.
But they can.
Um, sometimes sometimes then, Christina, it could be situations where there's something major. And like we talk about voluntary disclosures. So like
Hmm.
voluntary disclosure is like where, there's something that's been omitted, whether it's on VAT, on payroll, on some tax head. And if you go to revenue first, it pretty much mitigates the penalties. But the point is, I suppose, revenue can always charge penalties. but they definitely charge interest. And they're very active at the moment as well, I would say as well.
Okay. Okay. Looking for it.
Mm,
Okay. I know that we've had a couple of questions submitted, Tom, so I'll just run through some of those.
okay.
So is a spouse working in business also class S? We've been asked by Michael.
Yeah, potentially, yeah. So it could be a 50-50
Okay.
relationship there. And that happens quite a lot actually. Like Class S is what first comes to mind here. But given
Okay.
what we said earlier, like that'll be no different than a 50-50 stranger relationship either, right?
Right.
So I think, you know, my advice would be, even in that situation, maybe just get the scope clearance on that just to be 100% sure.
Right.
But yeah, I think that's where I'd be going at the moment anyway.
Perfect. Yeah. So possible, yes, but definitely just with a couple of considerations and to get clarity on. We
Yeah.
have a question here. As a startup, we have no employees yet, but should I register to pay PRSI?
Yeah. So let's say the startup is, it could be a sole trader, it could be a company. It probably
Yeah.
doesn't make a difference for this particular question. Yes, I would say so, because what you want to do at all costs is pay the minimum contributions. It costs a few €100 a year to make the minimum PRSI contributions to maintain your entitlements. Thinking of things like the old age pension, but equally like other entitlements, then that you'd be due. So you can do that anyway, regardless. So let's say when you file your tax return, you can pay the minimum contribution. I would do
Yeah.
that, no matter what.
Yeah.
Mm,
Yeah, that's it. It's about being proactive about taking money out of the business. Yeah. There's a lot of
yeah,
considerations as well if you're a new startup. We have our startup playbook starting in a couple of weeks. Keep an eye out and register for our webinar there if you're a startup because it'll have a lot of information there about different grants and schemes that you can get. But there's some of those that you have to get on payroll very quickly. So do register for that one. Then another question, being a resident of another EU country but director and owner of an Irish LLC, my director's salary excluded from Irish PRSI taxes, and I pay personal taxes in the country of residence. I have pension scheme in country of residence. Can I avail of a pension scheme in Ireland, and what are the annual limits?
um, you see, you can, the overriding rule, I would say, with pensions is that you can't claim tax relief twice on the same contributions. That's actually it in a nutshell. I had to just talk slowly just so I got that one out. Um,
Say
I
it again,
suppose
Tom.
you can't claim tax relief twice on the same contribution. So what my point
Okay.
there was, you
Mm,
pay in the other country, the other
yeah.
country, but equally pay. Like it could be a company contribution, for example. You can only claim the tax relief once. So I'm claiming tax relief on my Irish corporation tax return, or is there another corporation tax return being done in another country? But I
Yes,
can
of
only
course.
claim it once, regardless.
Okay.
Um, if it is a company, then I mean, you shouldn't necessarily be too worried about let's say the funding limits, because it's either a PRSA or an occupational scheme. Generally speaking, most Irish companies are Irish resident for tax, unless there's unless there's an agreement where it's not.
Hmm.
So by default, ROI, you could be on payroll in another country. That does happen. But equally speaking, then the company's more than likely Irish resident for tax. So I suppose, without going into too much more detail right here,
Hmm.
and just talk about the possibilities, that might be
Yeah.
one I'd say, just maybe just check that one out. But you
Yeah.
you wouldn't claim tax relief twice. That's the main thing.
Perfect. And then one last question that we've had, unless any other people want to submit any questions, any suggestions for turning directors' pensions that want to work past normal retirement age?
Could you just repeat that, Christina?
Yeah. Any suggestions for turning directors' pensions that want to work past normal retirement age? Sorry, I don't know if the question is very clear, but it was submitted in advance. So if the person that's
Okay.
on wants to jump
Okay.
in and clarify what their query was, it seems like
Yeah.
they want
Um.
they want to be able to work past normal retirement age, but they're concerned about a director's pension and contributing to that potentially. That may be the
Yeah.
question.
Yeah, yeah, yeah. I know. I hear you. I suppose yeah. At the moment, well, the good thing is for company directors, you can work till you can't. Effectively,
Okay.
you don't have to be worried about retirement rules.
Mm,
That's not really, it's not as applicable. Most company directors would take the start drawing down though. Like like that's the answer actually is if you can keep contributing effectively till you reach the max fund. The max fund at the moment is 2.2 million.
right.
That's where tax relief cuts off. So in a nutshell, most company directors would aim for maxing out at the max fund of 2.2 million. And it's not that you pay 2.2 in contributions, it's the fact that it
Mm,
grows over time to that value. And then
right.
you take your lump sums and so on and so forth. So
Yeah.
that's just my initial thoughts on that one. But definitely there's options there anyway for those who want to work beyond.
Perfect. Okay. Thanks for that, Tom. I know we're out of time, so really appreciate all of your expert advice there and breaking it down. I hope everyone has found that helpful. Just to call out our next session with Tom is knowing your numbers and cash flow. So that's going from compliance to decision making. So it ties into some of the themes we talked about today in terms of knowing your numbers in order to be able to make decisions at the right time for your business and for you as well. So do check out kinore.com/events to register for that. Thanks so much for your time today, Tom. I hope everyone
Lovely to speak with
has,
you.
yeah, I hope everyone gets out and enjoys the sunshine today. Have a good day, everyone.
Take care. Bye
Bye
now.
bye.